Yeah, how much do you do that? I mean, if it's that mom and pop nail salon, you're not going to give them $50.
So the rents are below market.
Then, I mean, that's even easier to substantiate as a landlord for coverage purposes, but maybe you got to recoup it down it. I mean, you're always looking to recoup that investment. Unless.
Did you justify it?
Correct. Yeah, I mean, that's the whole justification side of it. Because you're not going to sell a property if you have all these above market rents because you have given all these allowances for tenant improvements to have all the tenants lease up and have it be fully occupied. Because trying to sell it then, you know, and that kind of goes into the next part of actually the test, is that you got a bunch of tenants that are paying above market rents and you're selling the property, you know, no one's going to want to buy it based on above market rents, because if they leave, it's really typically nearly impossible to, you know, market is market.
Because there's no room in the deal.
Yeah, exactly. You cannot replace that rental stream. So market rents are very, very important. Now, there were some really interesting answers to this, and I gave some people full credit for saying, who cares about market rents? Tyler, you're looking at me.
Yeah, wow.
Well, how? I'll pose the question to you then.
Yeah.
In what scenario would market rents not scare you as a landlord?
If they had a long-term lease.
Correct.
Okay. I thought of that as I made that look.
That was an evil look.
It was an evil look. I was like, I don't get it.
So yeah, I
Wait a
mean,
second.
so it can be term. It can be, it could be the even today's example. So again, everyone's looked at that single tenant in Jupiter. It could be above market rents, but then you have Standard & Poor's BBB rated investment grade tenant. And you're like, okay, I'll take the risk on that above market rent because this tenant's got a lot to lose if they try to break the lease early. Okay, I mean, that materially affects their senior unsecured credit rating. Okay, so self-storage, it's a little different just because, you know, in some cases that above market 10 by 10 rent also could be that, hey, there's no 10 by 10 supply in the market. You're getting a premium because, and that was the other full credit that I gave to somebody who said that they didn't bother, because it's like, hey, maybe there's just no supply of that 10 by 10 in the market, and they can charge the world, you know, for that 10 by 10. So hopefully a seller or a buyer will appreciate that rationale, because at the end of the day, you are still very much wanting to stay within the market rate band so that you can have something to point to. CoStar, you know, REE for apartments, but CoStar for retail and office. You know, that's a critical piece of due diligence. That was actually, for this Jupiter example, I think we'll take a break and then we'll jump into it. But that was probably actually the third thing I did was go look at CoStar and say, okay, where are market rents in Jupiter for Class B and Class A properties in a 1, 3, and 5 mile radius? Okay, so you know, it's definitely important. So, but again, I like the rationale of some people with the market rent side of it. But I would say, by the book, let's just focus on market rent scaros.
Okay.
If you have a primary location, like if your location is the it spot, would market rents really matter either?
Always.
Like if you have
Yes and no.
the go-to corner on the block.
I mean, it's just harder for some people, and I say for buyers, if you're selling a property that has 100% of your leases are above market, how excited is a buyer?
No.
There's no upside in the deal. I mean, you're trying to create value in this business, whether it's through leasing, whether it's through expansion, whether it's through capital upgrades, making something a higher and better use to be able to grow NOI, because you can't always rely on cap rate compression. And is everyone following that rationale? I mean, you're just cap rate as it gets lower on the same exact NOI is only increasing your value. Okay, you can't really hang your hat on that. Okay, you hope that there's going to be some cap rate compression, but at the end, only what you can control is rents and how competitive your property is going to be in this market. So, yeah, I mean, that would be really unattractive for me as a buyer who's actually trying to be able to maximize my return on investment and return on equity. So yeah, that even if it's on Brickell Avenue, you know, and it's one of the best office buildings in the block, but you've got a bunch of tenants that are paying above market rents and, you know, big tenant improvement dollars to be able to backfill them, that sounds like an awful expense. You know, it's hard to justify, okay? Unless you think that there's this, well, and all that being said, I have heard people say, well, look at the office competition, okay? So there's no new office supply really coming in downtown because it's all darn condominium buildings again, okay? So maybe I will take a gamble. Styles with one of my other clients, Guggenheim Partners, just sold 800 Brickell for $108 million. This past week it was announced to a Deutsche Bank asset management fund, REE. And you know, I think my loan on that was like, I can't remember exactly what it was, but I mean it was, yeah, it was 68 million, I want to say, or and it amortized down to 64.
And that's how you say that name? Deutsche?
Deutsche.
I thought it was like Dush.
No.
I was always saying it wrong. I'm like, Dutch?
So you're not a German major. Yeah.
No.
But yeah,
Deutsch?
Deutsch. So, yeah, but a lot of above market rents in that building. But, you know, REE says, I'm really just looking for more of a static, consistent, predictable income out of it. And if some of those tenants roll, I'm just going to throw money at them, and they'll stay. Because there's no other office for them to go to. They're not going to go across the street. They're not going to leave Brickell. I mean, you got it, and some of these trust companies, I mean, that address is super important for a lot of people. So you're taking a gamble, but again, if you're a multi-billion-dollar private equity fund, different motivations than if you know, Robert, you're buying it, and you know, you're like, you don't have quite the checkbook as Deutsche Bank.
I've got a lot of patient capital, man. You're tripping.
I know, as you should. That's the way to look at it. As does REE. They'll own that property forever. But it's always, I thought Guggenheim was going to do so as well, but something's always, you know,
Guggenheim.
you'll sell it for anything. Sorry, Laura's.
So if there is no supply, then you can charge above market rents. Is that how it works? Or why would you, you know, if you charge above market rents and someone obviously wants to be in there?
Yeah, I was going to say that's a lot of tenant motivation.
Okay.
So there's no supply, and somebody's willing to pay above market.
Okay.
It's either because of the location or it's because of the size. I mean, there's definitely some reason why somebody would be paying on the market. Because I don't think you or I would be that excited about having to pay on the market if we didn't have to.
Yeah.
Right?
Oh,
Right.
somebody else.
So if there's another option, it's cheaper. We'll go, you know, the tenant will go with the cheaper option. There isn't any.
Yeah.
Okay.
And that's the perfect storm for a landlord.
Got it.
I have, you know, the downtown Brickell office. There's no new supply coming on really of any material
That's why
square
it's so
footage.
expensive.
And it's getting, I mean, I left the Four Seasons Brickell building because it just was getting out of control. The rent bumps were insane.
Isn't it the same way for residential though? The rental rates for residential are higher in
Yeah.
Brickell.
Wow.
Yeah.
Even though
Again,
there's
because
more
everyone wants to be
construction.
downtown. Yeah, I mean, there's not a lot of rental properties.
Right.
So, everyone's getting squeezed because that same renter is still unfortunately maybe able to qualify for a home mortgage, don't want to live in Hialeah, who knows? You know, so they're going to stay on Brickell. And the landlords are, you know, specifically probably for office and apartments downtown. And then look at the condo prices. So I mean, it's a whole nother animal. But yeah, no lack of supply is really, you know, supply demand. You're going to be able to then charge a premium, and if it goes past kind of that market band, which is always increasing, you know, kudos to you, Mr. Landlord. But it's hard. I mean, you really want to be able to, and it's a negotiation too. I mean, a landlord's always going to ask for more, and the tenant's going to be pushing back. The tenant maybe will say, well, if I really want to invest less in my space, because every landlord, or excuse me, any tenant comes in is going to put their own carpet in, right? Or sometimes they're going to say, Mr. Landlord, I'll go in there, but you got to put my carpet, or I want pink walls, you know, or I want purple shades on it. I'm like, I'm never going to do that. Oh, well, I'll sign a 12-year lease, and it's going to be at X, which is $4 kind of below the market high, because there's usually kind of a market band. And then, but I'll have 3% or CPI bumps, consumer price index bumps, every year. So, Mr. and Mrs. Landlord, you'll be able to realize, again, the cost that you helped me to get me in here. I will commit to your space, and you can have a proper return on that, cost to get me in here. So sometimes you can even rise through market with bumps.
All right.
I will say that's my concern of Jupiter. It feels good today, but we'll get into some of the other motivations of it.
So,
Yeah.
my question on that is, how do you structure an investment analysis if you're buying something for, say, today at 4.5 cap, and then you use more like a historical exit cap rate, like 8% on a 10-year hold? I mean, it's hard to get the numbers to work about.
I'd say.
Why, so then that goes back to like, why, I guess some of these institutional guys are holding things for a long time, but why wouldn't anyone buy something at a 4.5 cap unless are they running out 30 years or, well, on their, because it's a big gap between the 4.5 and the 4 cap that you're buying into the historical 8 cap like on office.
Yeah. Well, hold on one second. I'm trying to think if it was in the.
Because I was looking at
Third
the,
quiz,
for this
in terms
project.
of what's driving value, inflation, rent bumps,
Yeah.
all those new demand generators,
Well, because this project that we're doing now for the case study, not here,
Yeah.
for the competition one.
Yeah.
The assumptions that they have is the cap rates are really high, and it's like hard to get the financial model to perform with such high cap rates.
So
They have like a 9
what's their
on
going
hotel.
in and what's their exit cap?
Well, it's ground up construction, so, but the going out is 9 for hotels, 8 for office, 8 for retail.
It's really hard to work, huh? Yeah, so I mean, but the ground up is different than,
So I mean,
because,
just keep
because
going your
you can
construction
probably
costs
have,
until you get the numbers to look right. I mean,
right.
I mean, that's the only thing.
So it's certainly gonna probably affect how much you're going to, what's your build out for that ground up. I mean, if you're gonna build just a really, really pretty vanilla box, you can probably get those numbers to work. You're gonna have What's that?
Vanilla box.
Oh, inside real estate jokes?
No, that's right.
Oh, your group, okay. No, but I'm saying, so yeah, I mean, you're never gonna make that numbers work if you're gonna just have this really incredible bulletproof Class A office building.
Right, but when you do your investment analysis, what kind of cap rates are you exiting on? Are you doing like historical ones, or are you being, you're like probably 6 or 5%?
History's history.
Oh.
Amen.
Oh.
I mean, it's really kind of hard because
I mean, it's
look
shoot
at your
in the dark,
look
but-
at your interest rate environment right now. Can this be replicated 10 years from now?
No.
I certainly hope not, or we got bigger issues to worry about.
I mean, with the assumption that the rents are gonna increase along with interest rate bumps, but
Yeah, I mean, you're introducing new product to the market, right? So you're trying to be able to fill, your whole objective is fulfilling an opportunity that's not being met by the market right now, okay? So if you're gonna go and build something of Brickell standards out in Dayland, your numbers are never gonna work. Okay,
But
but,
they're doing it,
what?
but they're doing it.
They're doing it and they're crossing their fingers and toes. And, but,
I mean, they just built a spec office in Dayland, you know?
Right.
I mean, it was empty, but they did it.
yeah. And listen, that's a totally different motivation. That's somebody who's probably had the land forever, their basis is super low,
Right.
and they have a checkbook that they can support that spec, overhead, and the cost to keep it going, to running it, right? So, I mean, you got something dark, it's as if you had a rental house and no tenant,
Yeah.
but you still are paying taxes, you're still paying insurance, you're still paying an HOA or whatever it might be. So the cost to carry, you know, is important too. So, I mean, or there's just people who will build spec because they just know more than everybody else. And build it and they will come, right? Because there's a lot of tenants out there who say, I just can't visualize this thing. I can't, you know, I can see this gorgeous rendering that you have on your office conference wall. I need to walk it, you know, I need to see the dimensions, square footages. I might not need as much space as you're offering tomorrow, but today, I probably do. I got, you know, office is hard. I mean, that is one asset class that is shrinking fast. There are not a lot of people saying, I need 50,000 square feet and, you know, twice the 25 I have now. It's usually the opposite kind of question. You know, I'll go, now, I'd like to, in that lease renewal, I'd like to go down to 25,000 square feet. I will increase my term, but I just don't see myself needing 25,000 square feet 10, 20 years from now. Or if I do, I'll get it someplace else, you know, because I'll outsource, you know, that 25,000 square foot of overhead that I have. So, yeah, it's hard to exit at 8 and 9, and that's very much on purpose, you know, so that you can get these numbers. That's a thought-provoking exit to get to. I mean, because none of those assets. I haven't heard of a cap rate in an 8 in quite some time for a stabilized property. You know, so
10 years from now.
10 years from now, it's the norm. I mean, the Store Capital folks that we saw that video from, I mean, they are a net lease, just like Jupiter, just like a CVS. They don't buy them, but they focus on single tenant net lease properties. And this is their third REIT. They've sold the last 2. And this is their third company that they've taken private. And they're using the same fundamentals as they did in 1988. Okay? And so your yield has always been kind of for institutional returns on a leverage basis, no less, the cash on cash has really been no less than 8%. That's where you're getting that 8% number. Historically, it's kind of pointed to, that's where I want to be. Today, on a leverage basis, historically on an unlevered basis, but the interest rate environment right now, and there's been so much cap rate compression, it's really kind of hard to, obviously impossible to do that on an unlevered basis right now.
Yeah.
But, I mean, how many hotels are being built right now? Hardly any. Okay, office, spec office especially, is hardly any, if any, right now in some select markets. You can probably take some spec retail, you know, and get it off the street. You're seeing it on Hallandale and Hollywood between 95 and Federal. You know, building it so you can get Cricket Wireless and a nail salon and something else like that. That's a little bit of an easier gamble, but it's still a gamble.
You're gonna get hit with like a double whammy if you bought at 4.5 cap and then you got to refinance in 5 years, and then you're gonna get hit with a higher interest rate, cap rate expansion.
Yeah, I mean, and that's the fear.
Properties are
And
not
I
gonna be-
use
they're not gonna work.
Yeah, and I use the REIT example because it's very transparent. You can see the rentals, you can see the returns, you can see where their dividend marks are. But you've seen a lot of pressure on the REITs in a rising interest rate market and say, hey, can you still support your dividend? Can you still support this FFO growth, which funds from operations, almost like your NOI, you know, to your point, but it adds back depreciation and interest a little bit, just, so it's not taxable. But, I mean, these REITs have always stayed in business, and at 8% interest rates for 10 years, or 4.5%, what they are today. So, we'll get there, but I would imagine there's going to be a lot more pressure on cap rates going forward as rates rise, because you can't justify a 4% coupon. So, 4% people today are really looking for current cash flow and rising rents.
They need somewhere to place some money,
Yeah.
nothing to do with it.
So it's all, I mean, that's nervous. That
So
makes
what
you
are
nervous.
like 10-year holds or less?
Depends.
No,
As long as you can,
50.
Fred,
50.
as long as you're better.
Yeah, I mean, if you're buying,
So they go out of business.
if you're buying that, you know, I talked about that self-storage facility that traded for $400 million at a 4.25% cap rate, which is probably like an industry anomaly. You're holding on to that forever. That is,
But is there other pieces of that property that can be developed?
yeah, there's extra
That's why-
land, so there's
Okay,
expansion
fair enough.
opportunities.
Right.
Yeah, that's the other part of it.
Wow.
There's management efficiencies.
I mean, they could build
There's
a
no,
hotel on
that
the
was
spare, then it
all
makes all
cash,
sense, yeah.
you know, that was an all cash transaction, so there was no, you're not really bound by debt. So the bigger issue is that somebody's buying something at a 4.5% cap and getting 4.25% 10-year debt on it. I mean, yeah, you're gonna probably amortize it a little bit, but
It's free money.
10 years from now, can you really, you know, that's gonna be your negative leverage. There's no positive leverage
Yeah.
unless you can have some really hockey stick rent growth. So, yeah.
Like in the market right now, what are the benefits, like for example, constructing and buy something that it's already constructed and producing?
That's the test
A lot less
question.
risk.
Renovating.
I'll throw it back.
Renovating, without renovating it or renovating?
Renovating?
Who wants to take it?
That's question number 4.
Build versus buy.
Huh?
Yeah, build versus buy.
So what's the answer, Chad?
I couldn't come up, you know, because I thought about, you know, what's the advantage of reinvesting, you know, as a new investor. I couldn't remember what the book said. And the only thing I could think of this morning was for a tax purpose. Like you could potentially avoid a capital gains tax of selling and buying new investment versus renovating. But
Yeah.
If you're renovating, you also have 100% conditions. I mean, you can walk into a space and you think you're only budgeting the paint and carpet, you realize you need new air conditioning, or the city's gonna make you, update the infrastructure to get out of the station. You know,
Isn't all that on cash basis? It's hard to finance your construction costs in terms of renovation.
But you have contingencies, and then you realize that
You're going right up.
Exactly.
Yeah. I mean, I would say the answer is that is very, it's relative based on location, based on opportunity cost, and
Also,
time and funds available. You know,
I think-
to do such a thing.
I think
There's a lot of people who have a lot of pride in what they build because they know what's behind every single wall. It's either new, I did it, it's to my spec, I can do it cheaper than somebody else. You know, the sale leaseback, you know, they said I could build it and I'll do it cash, but I can build it cheaper and I can control the process myself to my specs. I can control it, me, okay? And then I'll sell it and lease it back versus having a contractor to do a build to suit for me. And then I'm kind of bound a little bit by the timing and the squabbling. So there's pride and time and cost to building. There's a lot of REITs today, and again, I use that REIT just because it's public and it's very transparent information. They're motivated to do joint ventures with private companies. REITs hate doing development because it's a suck of capital that they need for returns, dividends, you know, operating cash flow. They're a cash flow driven model, current cash flow driven model. They don't really, in many cases, care about IRRs, especially the single tenant REITs. But they say that I can build a CVS cheaper than I can buy one. So I've got to partner up with somebody to be able to build it at a better yield than buying it at a market rate that's 6 months old, you know. So If you don't have the opportunity to build it, then you're totally stuck, because CVS will only do business with people that are preferred developers. So, but using, I mean, it's a hard question to answer.
Depends.
It very much depends, yeah. I mean, if you can build it cheaper than buying it, and you have the expertise to do so, it kind of makes a little bit of sense. If you don't have the time, the expertise, or the money, you're gonna be focusing probably on renovating it, because it's gonna be faster, or maybe you can, you know, you just have that, maybe it's a little bit more design-centric focus to turning it around. Or you wanna flip it. You say, I have an opportunity to buy something at a very low basis, I can run with it, I can clean it up, I can stabilize it with great tenants, because I'm a great leasing and manager as well. And then all of a sudden, now you gotta consider the disposition side of it.
And also, I think something just on the inverse of that, if you're renovating a property, you can essentially skip the entitlement process as a whole.
Yep.
Which saves a lot of time, a lot of money, a lot of headache.
You got it. So I mean, again, it's kind of slightly slight motivations, but it's also expertise.
Yeah.
If you don't have the construction expertise, you know, a lot of people here aren't going to build their house. They're going to call Dustin.
I don't know about that.
I don't know about that.
Maybe not, but
Only if he gets a friend's family discount.
Yeah,
but it's like, hey,
that's what they want.
you trust him because he's the expert. He knows, he's a contractor. He knows how to do it, and he'll deliver it quickly and to your liking, and it's brand new. Then it makes perfect sense. If you say, I don't need Dustin because if I've got something that's got good guts, you know, the structural integrity of something is newer and it feels right, but I can just go in there, fix the fixturing, carpet, knock out some walls, then you don't need them, and you did it in half the time, quarter of the time. Yeah.
I hate to shift gears, but I was wanting to quickly just kind of talk about the open note part, because that was a little bit harder for me than the.
Let's take a break, come on up here, and we'll knock it out, and then we'll get into Jupiter for the last hour.
The second portion of the quiz.
Yeah. That's, come up too, because you and Chad have maybe the same question.
I guess.
My famous question. Are you getting all that?
It depends on the vibe.
It wouldn't be, well,
But for a hospital. Oh, okay. Depending on the other type.
That's not
We got
surprising.
on the Four Seasons, I got,
Yeah, no,
I
it's,
have to back your job.
yeah. That's what it's for.
You don't know what you don't know.
I am in the job.
Oh, I was.
Take our space over.
And then you're,
Yes, that was my old screen.
so what you actually, you project,
I mean,
get a
you're in
long.
the doghouse now.
Think it's
I'm in the doghouse now.
and you go.
No,
I don't know how short.
I did not want to spend $70
Way short of what it needs to stay.
That's what happened. Plus, I just, I have a,
Actually, we took over the space.
And he covers it, it becomes a cover. So you take the prices, we go, and when I go to his room, I'm like, who is this? They close the camera, but I
I want to go over it, right?
He's scary.
Because I wasn't very motivated.
I've heard about it, but I. Yeah, that's all.
Mañana, pues,
I haven't covered my people's front door. They're looking at my face.
But you could be doing something else.
So, this goes, I leave it open.
I had the corner office right there.
Oh, yes,
Yeah.
you didn't know we won.
Yeah, you haven't read it?
Yeah, I registered.
Especially when you have
What
prototypes,
contract
say you have a
is
prototype.
For development process, it's like section.
Wait, okay, not developers, like the bills. What do you
There's
do?
capital markets,
I have to take that.
land use regulation,
What I
Argus.
was gonna say was, I don't know if it was possible or not, there were some articles that we were
Is
supposed to
marketing
read, or maybe I just read them all, about them, a developer
Oh, yeah.
in DC.
Good for you.
I
was gonna ask you about your background.
I don't speak before.
That and Argus, you put that on.
Principal?
Probably
If
because of that
Kevin is
reason,
teaching.
probably.
Because one time ago,
Have no money there.
The land use regulation, training.
the capital market, capital market.
That shit was like,
falling down and you guys will be low. You'll be ready because you got announced. That was my first off the street class. I was like, oh man, you was just like you was reading the Wall Street Journal in class. Like,
Yeah.
oh, this guy. Then he makes you do a project. This big as a damn group project. Like yourself. You gotta get up. And I was all over it. You can ask them. It was like,
Oh, I thought
The last project was the Ponce de Leon.
reality is you want.
You know what I'm doing?
me either.
Put the
Right,
sale
no,
price
so,
on
you know, I
that.
mean, you might be willing to give us a little
But
bit
you have to do it.
to, if you
I'd
think
rather
your
do
work
a
is
sign
quality,
for that,
maybe
but
you
I'm
guys
not
have
gonna
done
work
work before, you might be.
How are you?
If you think
I
the
have
work
a
is
right
crappy.
there.
I looked at the website.
You gotta take that right out the front.
Yeah.
I didn't think it was it's that consuming and I can't.
You go to her.
This big projects are killing me.
It's actually not that too much. Wall Street Journal tell you about
Share with us.
case studies.
Okay, good.
That's how I feel about it, let's say.
Why
I'm kidding.
That's a good start.
that one is, that is the most
I'm so mad I missed that
far.
class. I don't know what I was thinking.
Yeah.
Because I heard finance. I was like, oh no. I should
That's
have because I gotta come back around.
Don't be too
Damn, I gotta come back around with some
You'll be a lot forever.
I'll be right there. Because what's he showing us how to do that shit?
He has a bunch of videos he has that you need to watch.
I'll take this summer.
No.
That's what I'm gonna do.
If anything, teach yourself.
That's the real thing,
Like construction, because you remember that time back there.
Oh.
The mortgage, you create the mortgage in Excel.
1 to 3 years.
So long. I figured it out. But
You gotta stick to your end.
putting formulas in there.
Yeah,
Practice with that.
So I was trying to
That's
get
what
you
you
Then
do.
statements.
So
It's
it's
like
the same.
less than 5%.
So, but really, where I'm right now understanding.
Not on the
Just the calculator.
Yeah, that's because.
These are the terms.
I can't.
But how do I compare like 3 versus 5? Vacations, we have to
This is the
Bring it
first
in
class
right
we
up
get
there.
to
like that, right?
Yeah, you can't do that stuff like that.
And it's doing it the right way.
Yeah.
So then I make costs bigger or whatever.
That's
try to
it.
get to that.
You know what I mean? So it's like,
You gotta have that type
it's tougher to bookkeeper.
Look at that
Oh,
30.
they did this, they go FASB 67. Oh, they doing this right now, they go, just categorize.
So that was scary about the Excel part, because I'm not a nurse, I know. So that's why I didn't think it.
That's actually the biggest.
No, but I'm saying like,
everything you do, you get your
We have ownership domain, we have all this other stuff, we have.
That's why
this
the
mark, like this rent.
good grades.
None of the other stuff's hard. The hard part is
Research ain't
don't have
marketing,
marketing.
but the answer, you know, it's a straightforward answer.
Well, no, I'm just saying what
That's
they
not
offer.
just-
Here's what you
And I never,
I ain't know that until the last class when we read that.
And you wanna kind of, you don't wanna.
Yes, right.
Endangered species?
Yeah,
That's probably one of the biggest things
No.
that.
You ask him?
no, it's just
You want to see stuff you're comparing to having what they gave you.
Right, because I'm already can't.
charts, right.
The cash flow.
Presentation, graphs.
So I would then count.
And I feel so bad. I want to take that shit again.
Oh, yeah.
I know, man. I was scratching. You do your presentation, you go to the slide, you didn't have
There was a two-time capital market.
Yeah, I was gonna say, but what
luckily it wasn't on the actual adopted law.
Right.
They're gonna be able to do that.
That is artifact.
I've done,
Same.
I've done artifact.
Or Indian or native.
TI.
But we did that.
Yeah, I'm sure here in Florida there's probably quite a
So how now he says if you want
Go
to
around, you wanna pay that job.
you need to meet with him.
You've been there, so we appreciate
Yeah.
3 years.
TI that they want.
Where that building was parked.
What are we talking about? Okay, right.
park.
Yeah.
So I passed it 3 years.
Yeah,
I have no grasp of it.
Right.
I was mumbling, it was horrible. And it was trying to do
Did you ask him? So what did you do? I'm strong.
You wanna go over?
So I picked it up as it went along, you know?
Bottles.
And I went first.
Wow.
They're all.
Fine.
Yeah.
And we had to be careful.
Yeah, this is the open.
check out, we got a.
Oh, you're just saying us.
And the only reason why little bug smasher was it's open.
That's
We had like historic designation.
Because I saw it in the book and that's why I thought that I had it right, but.
Shine. Only place in the bombs are all hard.
I mean, fine, when you're up here,
They actually shot this airfield in one run. That was it. And so,
Well, can I
we had
get
down.
numbers?
Yeah, all I've heard for one of my guys was that, when you turn it, even when they try to renovate it, it's like they're just throwing a piece.
You get used to the same thing, you know.
Whereas everybody else could, you can brand new, you can new construction, right? They tear it down, they won't tear it down. And they just threw it. It's awful, and it's just like, yeah, but it's the sign, right? Because somebody's looking on it.
Yeah, starting out, I was remember like, still concerned, think everything's going great, next thing you know, you like drop 1,000 feet.
Yeah.
It seemed opposite to me.
Yeah.
The first time I started out, and then it was, oh, here's going to be the right part of it.
Well, and you overdid, I always do that.
Yeah, we
But it's also easier when you're a faster contract. It's like a wave runner, you know, the idle speed. It's like,
Can we jump in this?
yeah.
Ask.
I'll tell you what's in it.
Or ask while you're out there, what you want to add to is a like what you have out there. Good talk. I know, and we only have 40 minutes.
I don't know.
Okay. Well,
What can we do?
paper, they don't want to the numbers, everything, you always just get it current. It's just, I was like, I want you to
Not here, no, links below the,
Let's open the references.
Answer everything.
Those are just concepts you have to have for your
In the first one, like I had like 4 wrong. No, the
Yeah, at the end of the day, you don't have to feel like you until we have.
Actually,
Yeah,
some days,
you
yeah,
can
no.
go without how much they want. They do like be required on the contract. Native American, the origin, Aztec, Comanche, almost everything in the military.
Question and answer.
Usually we have a
Oh,
problem.
we can take time. Like react,
Yeah, I gotta go.
very like,
I would
we need this
tell
now.
my mama there.
So, you know, especially when you.
I want you to get up to speed because I don't want to.
Conceptually,
You're there, you're living.
This is the difference between you being safe and not being safe. You want to start over? Wednesday. Wednesday, I mean, like, so,
I mean, just from.
stuff with the local
With
business.
like the
Water district facilities, government renovations.
That's so sore when I got out there. Yeah, DC is, you know, blows.
Yes, that's right. You know, I
There's a scope of work.
Can't be open.
Yeah, it has to be.
They do have some range and everything.
And like, I'm more in the street, you know, I learn out there, I learn more there, like 5 hours.
And then the 91 will.
We gotta run. We talked, we basically.
So I'll send you the link to,
But they're experts.
I don't know, I just want to see something that is once you like really lose transparency, it's good. And so they're engineers. As long as they fly, they're engineers.
And then you gotta do.
3 engineers is not even enough to consider yourself like totally safe.
Right. So I would, you would have to do is take a picture of that first. You have to get the scope of work first. They're a little bit.
I was gonna get that like
How it works for the city. Sorry. Now the bonds, before that.
The group projects are, you know, at least the other ones. Yeah, it is, it's overwhelming. This semester is pretty good.
I don't know what you're. Whatever you release out, you never know what's going to actually the quality of the product.
You know, there's the whole thing, they have
Send me an email.
When we go there, you would
You think like that propose a different. Rule that answer. So it wasn't. There was always. I know that Sort of. I mean, like we were close enough to some other. Let's talk about it. Let's get through this.
More important thing is that there are, I am trying to it's evolving. I'm going to get contracts. That I know because money is only about I'm trying. Don't do it yet. I all got a brother that
just walk you through.
I was just contracted as being taken care of a tribal power in that specific region. You're right. And we do the same thing. So we were building all these state it's a little, KBR, you know, all the other things that went over there. Are they building it? So at first they were bringing third country. American companies are trying to contract. What do they do? Make sure they're acting as.
You have a lot of
I don't know. Yeah, the general contractor. They're just going around and
all the inspections are there.
That's right, they're project management.
But they have engineering, some of the guys.
They understand the engineering. Like sales codes, they're not gonna be able to check bricks and mortar. But not one American is built on brick and mortar. And then, as we went on, we were like, hey, stop using third country maps, bring in this further economy.
So
they take, they cut off the proceeds, you know, because you really mean that's not gonna go back to land.
There's that temptation.
I mean, they
really don't want to make a deal. We're going to be getting this and that.
That's what I did.
But it's not the airport.
And they paid them pretty well.
But they're very hammered if you make that
contract for
No long decision.
generated on a much smaller base, right?
Well, that's, I know you guys are joking.
You know, but I wanted to.
And so I wanted to bring the big base.
I can tell you.
Check out.
You have a lot of
Work at it.
Yeah, you just have like.
Didn't seem like easy.
I'm gonna talk about that. Jump and we'll chat. Can everyone sit down for a quick second? We got 35 minutes. So log in. If you can, access Riverwalk Center at Jupiter Yacht Club. So yeah, grab the PDF and the Excel. Before we jump into this really fast, because this is
I downloaded it.
probably something that
I downloaded that.
everybody has this, right? Has access to this? Should be in everyone's inbox. But.
Yeah, I can't get access to my email, so I'll look on. I'm having issues with my Outlook. It's just not, I haven't had it for like a week.
Call your computer guy.
Log in through Exchange.
What?
Yeah, separate.
The web-based email.
Oh, they fixed it, man.
Like I went on,
Everything's-
Notebook, and Sharp, and then I click on my email, and it still doesn't.
No, go to exchange.nova.edu, and that'll be your web-based
Okay.
email account.
Can you write that down?
And then it's just your username and password, but you're getting it from any computer on the planet.
Exchange.web?
Exchange.nova.edu.
Okay.
Do you have a login for the computer?
Yeah, for the Wi-Fi. I forgot what it is.
Robert, didn't you? write it down, didn't you?
RM32.
From Jeff?
RM dash.
I got it in my email somewhere.
Hold on, I wrote it right here.
I
I've
unfortunately
given it
don't
to you
have
guys
it.
so many times.
RM32?
Dash 423.
Every week.
Yeah.
You guys got
Capital
me
A.
searching.
And then ask you.
At PC.
Right.
I just need to get started with it.
Okay, got it. I mean, it downloaded anyways.
Okay. RM32.
All right, so office building in Jupiter. Little over 35,000 square feet, 100% net leased. Tenant has full obligations to. Can everyone hear me right now, or should I speak up?
Hey, we're good. We can hear you good.
A little louder.
Good.
Good in the back.
Just yell.
Can you hear me now?
Jen Spring Family Office is the tenant, which is a wholly owned subsidiary of SunTrust, rated BBB+ by S&P. Investment grade tenant, net lease. They have responsibilities for everything from an operating perspective. Okay, landlord has nothing.
Ish. The landlord does have responsibility for HVAC system replacement. Right? There's like goofy stuff in there. Like
It's all under warranty anyways,
Oh. Okay.
typically. So you don't really look at it as an obligation. So that's an underlying responsibility. But nothing from an operating perspective, that's again CapEx. So, because it's replacement, and because you'll notice it's replacement, not maintenance.
Right.
It's a good catch. So that's again, ongoing issues with HVAC is going to be the tenant's responsibility. They're going to call their AC guy. They're not calling the landlord.
Yeah.
If the AC guy says this thing's toast, landlord steps in and says, I'm going to get a second opinion. And if that opinion comes back negatively, then landlord's going to be writing a check. Yep. Okay, so a little over 35,000 square feet, investment grade tenant, single tenant. It's good through March of 2022. Short lease. We are looking at a rent per square foot right here. Again, bringing it down to kind of a relative level. You know, $870,000 in remaining average rent really doesn't tell you anything other than, wow, that's kind of a nice annual rent. But 2252 today, lower end of market. All right. So the 12,730,000 asking. When you look at it here, does everyone grab the Excel really fast? And look at J11, you know, that's pretty much as good as it's going to get. 344 bucks a foot in your purchase price. So, or is it I think the other one was like 12.8 or something like that. Whoops.
What do you mean by that's pretty much as good as it's gonna get?
From a relative perspective, BBB plus credit is pretty darn attractive. Okay, I mean there's incredible strength of tenant, SunTrust is guaranteeing the lease. They have a lot more to lose than gain by saying I'm going to break this lease early. They don't really have any, really many negotiating levers to pull, and they're certainly not going to walk out on a Saturday night because then that is a material default, which will then affect the parent's credit rating. Okay, so
That's SunTrust?
yes, as the lease guarantor,
Right.
you point to any defaults, any of the kind of if you're in default of rents, or if you're in default of any maintenance issues, those responsibilities, if you're not paying your real estate taxes on time, because it is your obligation to pay the municipality, due date, all those will run up to your guarantor, which happens to be, which is a very good thing, your BBB plus rated guarantor, not Genspring, a subsidiary of SunTrust, who's rated 0, or has no rating. So that's a very positive to pull out of this.
That's correct.
Do you know if this was built for this tenant, or was it just built on spec and they sort of built it?
I don't know. I would suspect that it was probably built for them, being that it's Jupiter and it's their kind of private office, ultra high net worth clientele. So it's really well, as you'll see from the pictures, it's really well built out. But I couldn't tell you in 2005 kind of what their cost to build. But I will say, Chad, as good as it's going to get, putting it in a relative basis, I mean that's BBB plus is the same rating as CVS. Okay, you see those trading in like 5.5 caps at $350 a foot in purchase price. So relatively speaking, what's the alternative for your equity? Okay, based on rating, location, square footage, ability to retenant, both the space and replicate the rent. So relatively speaking, a CVS is typically half the size. It's plus or minus 14,000, 15,000 square feet, depending on which their store plate they use. Half the size, typically paying 30, 40% more in rent. Usually the rent per square foot is going to be, well, it's a function of the dirt cost going in, kind of, I'm drifting a little bit away, but it's going to be the same credit profile, same rating, BBB plus, half the square footage, typically 30, 40% more in rent. So if you look at it on a relative basis, $22 is a little bit easier to retenant. 35,000 square feet is a little bit more difficult to retenant. CVS leases are typically flat for 25 years. This only has 7 years left on it, or slightly under, and there's 3% annual bumps. So this, whole IRR model, we could probably even break this down into also the net present value of it too, is to, the term versus the retenanting costs, relative to the same credit profile. Does that somewhat answer your question?
It does.
So you know that it doesn't cost $344 a foot
Because
to
you
build
go
this
look at what
building.
CVS is paying,
Right,
market rate.
correct. But they'll pay $38, $42 probably for this same corner in Jupiter right now. Now again, this is a 10-year-old building too, so you know, costs have changed differently, kind of pre-recession, post-recession, as well as land values. It's come way back. So yeah,
Why do you think this is one that you're looking at, right?
yeah.
Why do you think they're asking what seems to be below market for this building?
Below market, what's that?
Well, just with the, 11.5 cash on cash return. Just seems like they're leaving money on the table, selling it now. Like triple B.
We'll get into that. So ask that same question
Okay.
in 10 minutes. And the only reason why I say that, and we'll go through this really fast, because I want, this is now we're going to be able to look at, you know, the sensitivity analysis right here, IRR matrix distribution. All right, so this is where all these wonderful numbers that we've been creating are really shown in a concentrated box. Okay, here X, Y, Z has to happen. We've talked about kind of cap rates widening. You know, people buying at 4.5 per your NAIOP, you know, situation. You know, I'm underwater by 3% if I have to exit at an 8 when I'm pretty much going in at around a 6.5. Okay, so as you point out, you can't make the numbers work based on historical cap rates.
Right.
Well, I hope history is history, because I've got 3% bumps in this lease. I have BBB plus credit, but I have no term. So there better be, and really the gist of this exercise here is that there better be a pop in value after 7 years, or I better get the tenant on behalf of, you know, it is SunTrust, but GenSpring to be able to renew, you know, and carry out that credit, because this is more of a credit play. You know, going back to Chad, is why is this as good as it gets? Well, in summary of it, and then we'll kind of back into why, but I have a ton of heartburn over the fact that the going in purchase price is $344 a foot, even with rents growing the way that they are. Even if I use the same exact cap rate, the exit profile is even worse. And worse being, is anybody going to pay, you know, $450 a foot for this building 7 years from now when it's 17 years old? You know, even with, and then it could be, hopefully, GenSpring's still even there. They could be gone. All right, so and that's why I want in this, so also be mindful of the single tenant kind of component to the group project too, is that you can get, you know, some great CPI, you know, growth here. But cap rates have to stay at 6.5. You know, this IRR works with the CPI growth. It doesn't. You know, I can't make any economic sense of putting my cash into this deal today if my best IRR case scenario is going to be cap rates widening out 100 basis points. There's scheduled bumps in CPI here that I can point to that are 3%. So it's a 7.5% IRR. I mean, I'd rather go buy a REIT dividend than have to take fee simple, illiquid risk in a single tenant.
That's unlevered?
Yeah. Yeah, everything will be shown as on an unlevered basis. Now CB will throw in the 11.5 some moderate debt assumptions.
Okay, I got you.
Just to make the package a little sexier, but that's certainly far from the case. You know, they figure everyone's going to get leverage on this to make it, because putting 7.5 there, everyone is just like, you know, it goes in the trash. It's not even.
That's a leverage. That's what leverage there.
Yeah.
The 11.
I think I'm pretty.
I thought that was unlevered.
Usually not.
No.
Not with 7 years left. There's definitely some debt in there. But we'll get into that a little bit. But anyways, so taking a quick step back, great looking assets. Okay, good credits, great location. Love the location. Okay, there's really no real dirt to be able to have Gen Spring say I'm going to leave and I'm going to go build my own, another new building down the road 7 years from now. Feel pretty good about the lease renewal probability, and the credit is icing on the cake. That feels pretty good, at least for the cash flow for the next 7 years. But I use this example really that building's nice, location's nice, credit's nice, but there's a big per square foot exposure in this in only 7 years left. You're only really holding this thing for probably 3 years, or you're going to have to hold it for 10 years. And why would that probably be the case? Take a stab at it, anybody, yeah.
And you can't sell it 6 years with only 1 year left, no one's going to want to buy it.
Yeah.
So you
I
gotta-
mean, your
you
cap
gotta
rate,
redo
it's
it.
going to be 8%.
Yeah.
If you've got 1 year left on it, because everyone says Gen Spring leaves in a year.
Yeah.
And then what do I do? Then I got to write a check for tenant improvements, and I got to market the property completely dark. I'm going to have to feed debt service out of my pocket. That's just an incredible. It's a lot to ask. And so, with 7 years left, it's very timely that this is coming on the market when it is. So.
When you say it goes up, might be an 8 cap rate, is that because whoever's looking at buying it is adding in all of those expenses and then kind of redoing curve to figure out what they're coming up with a new valuation, which gives a different cap rate for the same income?
Yeah, and it's probably
It's like a risk.
It's probably less IRV because, and it's probably more return on equity driven. It's more IRR driven in that. Look at closer to what I'm buying at dark value as it's vacant. Okay, so I've got 1 year. I'll roll it with 1 year left. Gen Spring probably has a 1 year notice in their lease, and I think they do. So 12 months prior, I'll know if they're staying and executing an option, or if they're gonna leave. So they give me 12 months notice at least.
You got to count on them leaving.
So, but you have to count on them leaving if they haven't given notice. Right. And so it's more of, okay, I need to be able to buy it right, closer to dark value, and then closer, and then being able to tie out. Okay, if it can be multi-tenant, or if I have either another single tenant user, or if I can stomach the time and cost to convert it to a multi-tenant building, that I can actually then exit out of that at a level that it can be money.
Okay, so the higher cap rate is I need to purchase it at a lower amount to make all the numbers still work.
Correct. Yeah, because you're still buying it on cash flow.
Yeah.
Right. There's cash flow there, so you're backing into the cap rate that then you can justify the time and the cost. Worst case scenario to retenant.
Right. Okay.
So in my calculations, I said that Gen Spring, you got to always imagine that they're going to leave. Okay, so you've got great demographics, great market, not a lot of office competition. Right next door to some really high quality retail, a Wyndham Grand Hotel, and really good strong traffic patterns. Yeah. Okay. So from just and I think as I kind of alluded to, and kind of the corporate twist that I put on this is I want everyone to really kind of hone their real estate gut. Okay. So that you look at this and you say the first thing that you don't just throw everything into Excel and does it work or not. You got to look at the offering memorandum first and say, okay, what are the guts? Okay, kind of investments 101. Do I like it? Is it competitive? Is it going to be relevant in the marketplace? There's going to be some strengths. There's certainly always going to be weaknesses, but bidding on it is, okay, I've got enough mitigants to those weaknesses where I think that I know enough about the story to make this thing a really good cash flowing property. and I can anticipate a pretty good strong disposition. So, walking through, okay, so we do some quick due diligence. It's not that far away, and hopefully people know, US 1 is typically all the way up into Palm Beach County, is about as good as it's going to get, from a density, from land availability, or I should say land scarcity perspective, and traffic. And it's just traditionally your highest demographics are going to be closer to the water as well, and you know that Jupiter is a very, very wealthy Palm Beach suburb. All right, so that's the very quick sense. So we've got then all of this annual rent broken out with all the growth, compounded rent growth, and now it's kind of to the point where, all right, I think the market and the asset itself, 10, 12 years old, all that feels pretty good. Let's work on let's kind of look at the lease. Let's look quickly at the financial side of it and break down what 7 years left of cash flow is going to look like. Nice bumps, for, like I said, BBB plus relative to CVS, similar credit. Usually those leases are flat. Here we've got the same credit. We've got obviously a relevant tenant to the marketplace with the amount of wealth that's in Jupiter, and the credit on top of it. You feel pretty good about their ability to pay rent. Speaking of rent, $22.52 going in is on the lower end of market. So despite this still J11 sell, the $344 a foot is very much on the high side. As a percentage of cost, as a percentage of dark value when it's vacant, I don't know of many people who are going to be buying a dark building that's for $344 a foot that you can really make really decent sense out of it. But that feels pretty good too. Okay, no landlord responsibilities. Hopefully you don't have to hear from Gen Spring or SunTrust for maybe once or twice a year. I would say would be best case. So the lease fundamentals look pretty good in a triple net basis. Questions so far? We're kind of doing it on a fast approach because we have 12 minutes left. And we will be jumping back into the Excel of this in the next class too. Actually, next Saturday, no class, FYI, too, because of the holiday.
So the next class, we're going to be jumping back into this?
Yes.
Okay.
Oh, yeah. So again, attractive building, you're always going to get the nicest photographs that you can possibly find. So you got a lease analysis, everyone's already gone through it, no tenant responsibilities. Really, really pretty build out. Like we pointed out, great retail corridor. Site plan, no room to expand, obviously. But
Floor plan.
and here's going to be your lease abstract. Obviously, everybody, from a due diligence perspective, already kind of nailed this. A little bit more about the operations heading out of the property, and then also the financial highlights of your BBB plus guarantor. So, any other questions on kind of the lease, what you're looking for? No. Okay.
Do you have the appraisal costs on the cash flow spread out because you're making payments, monthly payments or something?
The what again, sorry?
Appraisal cost,
Appraisal cost?
looking at them like spread out through.
Yeah, so there was just one, that's one cost that I kind of amortize a little bit. Because I also have third-party equity, usually I'll get it revalued and I'll come out of pocket for it. So that I can point to the annual value and annually adjust pretty much our cost basis into a new market, perceived market value. So it's almost kind of like a mark to market. It's not far from required. Most people don't do it, especially on a single tenant deal. If you're paying rent, who cares really about what the value is unless you're thinking about if the market's changed, is it time to dispose of the property on an ongoing basis, yeah. So if you have third-party equity, you owe it to them, relative to know where you're sitting with regards to market based on where your cost basis is year to date. So when we look at investors, the key ratios in terms of the rent escalator, rent escalator, commissions, you'll see all those key ratios are pretty important, and you've seen it in all the other IRR models, but everyone has it in front of them too, right? It's kind of fuzzy up there, so I'll look at it. But this includes both the costs up front, ongoing costs, exit considerations, and then I also kind of threw in a little bit, because I want to open it up for questions as to how your equity partner, third party, might be influenced, and how you as a general partner, are going to be influenced to be able to kind of maximize your returns. So does anybody have any questions on kind of the overview, assumptions, why these cells are talking to each other before we kind of jump into?
Matt, are you looking at this for yourself?
Yeah.
Or, okay.
Yeah.
Interrupt me, bro? For your private equity?
Yeah.
Is that okay?
Yeah, this is actually kind of a live.
You want us to give you a yay or nay on it?
If you'd be so kind.
How long did this take you to put together?
How long did it take? I don't know, half an hour maybe?
Yeah.
Couple of sleepless nights.
So
What's
this is
an
a model that you use for other projects?
No, I just.
Every project is different, it has a different setup, right?
What's that?
Do different
Yeah, I mean, every
projects have-
deal, this is a single tenant deal. So, I mean, this is only going to be specific to one asset, one lease. I did kind of throw in different phasing so that you could consider what some other variables would look like. But, and that's why the group project is single tenant, because the variables with multi-tenant assets is going to be pretty involved, because every one of those tenants typically has its own renewal probability, its own, it's on the first floor. First floor tenant has different variables than a fourth floor tenant or something like that. So I mean,
Oh, great.
and to get those,
Love it.
And Dustin to try to get those numbers to work. I mean, it's going to be trying to make suitable assumptions for a multi-tenant deal.
But
So
if you put it in the Argus model, it'll work it out, right?
Correct. And are you guys using the Argus on the?
We're learning how to use it.
Okay.
And do you use Argus or do you use Excel, or you use them both? Or do you use more?
I use Excel for single tenant deals and Argus for multi-tenant.
Okay.
Again, because Argus you can make assumptions on a per tenant basis. It's much harder to do it in Excel. You can do it in Excel, and I actually can't say I always use Argus primarily for multi-tenant, but this is just typically cleaner, and you can click through it faster and can reference it.
Right.
Argus, as you guys are getting more competent with it, you'll notice that you're constantly clicking through and then having to look over here, and sometimes you forget about what it looked like over here. So I'm going back and forth a little. So, yeah.
What's a equity multiplier
Where are you looking at it?
on your distributions?
Oh, you're way ahead. Hold on a second.
Yeah, we sources and uses.
Hold on. All right.
I got like 5 minutes here.
No, we will definitely be jumping back into this.
Okay.
Yeah.
Please.
This is good stuff here. We use this on our project.
Get some great stuff.
See, I don't want to give you any of. Fred already walked in here, so I mean, professors.
Oh, hey, there he is.
Unfair advantages going into this, but I want to be able to at least give you directions. And by no means is this the Bible. So, as professors in the back looking at this, he's going to probably make note of all of these worksheets that you're not going to be able to copyright. I should have copyrighted.
He empowers us to use
This has already been distributed.
It's been widely distributed. It's too late. Okay, so pro forma. Well, let's get through all this. Very similar to the overview assumptions. Kind of the capital stack equity is going to be plus or minus 3.8 $6 million. I will be using, there's a loan here, there is a debt assumption that you'll see, and it is, yep, 3.6 million, which is about 28% of the total cost, because again, you're looking at probably about 14.4, which takes into consideration your upfront closing costs and those reserves, as you pointed out, appraisals. What's that?
The closing cost, we were talking about the closing cost, like how you have to include it
Oh, yeah.
in our roof project.
That is
It's
a
important.
It is slightly important. Yeah, slightly important. So a lot of this pro forma is really right out of the offering memorandum. So you're going to be relying on CBRE in this case, that they're representing and appropriately all the cash flows. However, you never trust anything that they put into that offering memorandum, so you're going through the lease. The lease abstract helps. You can do it. Your lawyer will do it for you at a cost. But at least, again, it's just another set of eyes to be able to make sure that all of this is jiving. So, cash flow before taxes, all these are assumptions based on history. Now, again, this will change in the pro forma basis because there are still rent bumps, because there are unknowns with regards to real estate taxes that will be changing with new ownership. Insurance costs, very well could possibly change too. But again, those are tenant's responsibilities, so they shouldn't. You got to keep your mind open. So NOI with a cap rate of 6.5 gets you, to hopefully an exit of about $15.825 million. All right, and that is making a lot of assumptions, positive assumptions with regards to NOI growth and the ability to keep GenSpring in place and paying contractual rent. And what I'm hoping is within kind of market levels that somebody will pay, quite the same premium on a per square foot basis at the same unlevered cap rate. Questions so far?
What encompasses the disposition fee? Like what's in
What's
that?
it about?
That's an internal. I pay myself that.
Oh, makes sense.
Yep.
Smart man.
Yeah.
Pay the bills.
Just at 2.5.
Yeah, that should go up a little bit.
So you see that 1.5% commission?
I see.
See the 1%? It's in there.
Disposition fee. I should incorporate. I found one to incorporate.
All right. So here's going to be your debt coverage ratios here. So, this certainly feels pretty right at a loan amount of about 75 LTV.
Okay.
Dustin, what was your question on the
That equity multiplier?
well, actually, yeah, sorry, let me get back to that.
Yeah, it's on distributions, but you got it up here too. On the,
Yeah, I've got it in the pro forma as well, but let me get through the rest of the cash flows.
Is this how many times you're doubling your equity?
Correct.
Put in 100,000, it's 1.5, you get back one.
Ongoing plus exit, yeah. Does everyone understand that?
Say that again?
It's just going to be simply your ongoing positive cash flow plus your exit is just going to be that multiplier. It's almost kind of like a debt service coverage ratio. So you're 1.5 over your debt service requirement on an NOI basis. It's the same thing as what your return multiplier is going to be. Some people can look at it on a IRR basis. Other people want to look at it as just how much money have I made on top. 1.0 is my equity. What's my multiplier been on top of that? Does that make sense?
So you just take you're not taking the acquisition cost, just the cash flow and the exit?
It depends if it's me or my equity partner, because I've got a promote, as you'll see in the overview here. I found the deal, I managed the deal, and there's a promote in there, so my multiplier is going to be different than my equities. Yep.
Are you investor Z?
To be determined. There might have to be Z-1 or something, I don't know. And, all right, so here's your beginning loan balance, $9.2 million. And then, so you're assuming here's gonna be how it amortizes, right? Payment static, it's fixed rate, it's non-recourse CMBS loan at 4.5% with a 30-year amortization schedule, okay? So there's gonna be your ending balance with, including reserves, okay? So that's pretty static. 9.2 million.
Is there a reason that year 4 is bolded in black? Is that like just like a decision point?
It was a consideration to sell in year 4.
Right. Okay, that's what I thought.
Or in year 8, once the lease renewal has kicked in, I'll throw it on the market and sell it immediately. Because I don't want to have to take that rollover risk again. But again, this is just for sensitivity purposes and how cash flow bumps and assumptions will affect timing where I can still think I can, get to my IRR hurdles. Does that make sense? As we kind of talked about it, you're going to be a few years before that renewal or immediately after, once you have time for another investor to come in and pay you what you're hoping is the right cap rate at the right time, with market rents being understood and appreciated, not being too high. Again, you're going to be right in that band.
Matt, on this deal here for you and your investors, are you just trying to put money somewhere and make some yield? I mean, is there really any value add? Is there really any?
It's kind of a combination.
Right.
So the play is twofold. Ongoing income on a credit basis with an asset that you can actually break up and realize higher rents. Okay, market today is like 28 net. We're 22 and change here.
Okay, so you think you can grow this?
So I think I can
On renewal?
on renewal, yeah, unless I buy them out. I mean, the other play is maybe approaching GenSpring and say, hey, do you guys really need all this space right now?
Right.
You tour the property during due diligence, and is everything being utilized? Is there some back office space? Do they really need 35,000 and change? Maybe they need 20, and maybe I can take the 15 back and lower their, keep them at the same rate. But is there a way then to chop up some space and get 28 bucks today?
Right.
So I'm and then kick out that lease term 10 years or something like that. I'd love in a perfect world to take back half the building.
Sure.
Maybe it's the first 2 floors, and GenSpring can have the penthouse or whatever it might be. They can keep the 22, buy some time. I'll give them an option too. Maybe it's a lease for 7 years on the second floor. GenSpring, if you guys want it, you can have the first option to take back the second floor or something like that. Okay, so that's where there's an ongoing income, but there's also then the ability that
Potential.
GenSpring leaves. Not though excited about what I think is going to be $20, $25 a foot, and who knows time-wise, a year, to be able to market a dark building to break it up for multi-tenant purposes. So then it's the math that we've worked through individually here, but for the group, justifying the return on cost or to break down walls to make the building more accessible for multi-tenant purposes and achieving market rents at that point. So the real drivers is, hey, I've got credit, I've got below market rents or very reasonable rents, and perceived upside, but it comes with a cost.
Does your cost of available debt today sort of factor into your thought process at all, or no?
No, and I'm using 75 LTV debt because of the below market rents, and it's 10 years in term, so that I can have time to re-tenant if GenSpring leaves.
Right.
So I'm going to collect probably $1. The lender's going to collect $1 per square foot for the first 7 years, or during the 7 years of GenSpring still being hopefully in place, open for business, and paying contractual rent. Three tests that every lender will use in order to give full credit to a lease. So a tenant's got to be in place like we are today, you know, that it's a functional space, open for business. The lights will turn on, they welcome customers, whether it's office or retail or, you know, whatever it's going to be, and paying contractual rent. And so those three are really, really important when you're looking at a building that, hey, if GenSpring was leasing the whole space but using only 50%, as a lender, I have a hard time giving 100% full credit to their lease, right? I mean, I'm going to give them, I will give them a discounted, I will certainly discount their rent that they're paying because it's not really usable. Okay, so those are three tests. As an investor, you don't care that GenSpring is paying, you know, the entire rent for the entire building, because all you're looking at is just the rent collected. Okay, if they decide that they want to take less, that's maybe in this case your upside. Okay, but from getting a loan perspective, that dark space or underutilized space or just dark space that somebody could be paying rent on is a big red flag.
You don't think in general people are just trying to tie up low borrowing costs?
I know a lot of people that are motivated by low borrowing costs that are buying. I mean, yeah, this is a very fringy deal for me. I don't really care for it that much. I got to be honest with you. It doesn't excite me. Typically driven by, as I've pointed out multiple times, you know, this number, $344 a foot, is just. I mean, this deal in a perfect world. In 2010, if there was a very motivated seller because they maybe had other issues in their portfolio or needed to raise some cash and had to sell this because they would have made money even on it then. But this would probably have been, you know, this probably would have been an 8 cap in 2010. I mean, it was an awful time in commercial real estate in South Florida. And so motivated seller, you know, an 8 cap here would have been $250 a foot in purchase price. That, you know, as a fraction of a construction cost just feels a lot better. You know, again.
What's the asking cap on this?
It's like, I think they were asking like 6, and I think because they were asking like 12,750,000, I want to say.
So what factors more into why this is not a super exciting deal? Is it more just because of a limited potential upside, or just overall deal size is not what you typically like?
It's kind of small, from a deal size in 35,000 square feet. I mean, you usually want to be able to get into something where I like bigger deals square footage wise because there's more opportunity, there's more things you can do with a building. You know, I mean, you can consolidate spaces and make bigger floor plates. You can shrink it for smaller users, maybe get more premiums out of them. So the deal, dollar amount and square footage, kind of small. You're limited. The going in per square foot doesn't excite me. The 7-year term, that event in year 7 during my 10-year loan term is going to certainly cause me to stay up at night. You know, what else am I going to have to do if GenSpring leaves, feeding this thing? Right. You know, I'm coming out of pocket after they leave. When it's dark, I'm feeding debt service. Probably going to have to spend $25. What's that?
Isn't that your opportunity?
It is. It is. But you know, if you're not Reef and Deutsche Bank taking down 800 Brickell, and you don't have that same checkbook, that time is money, you know, as they say. So yes, that is the opportunity. But until you realize that opportunity, you're going to be feeding debt service. You're going to be having to probably, you know, $20, $25 to re-tenant this into multi-user space doesn't excite me. And then after all that being said, you're most likely not going to get the same credit profile of your tenant. You're probably not going to have that triple B plus credit, excuse me. And that's playing into a function of the yield today. So if you don't then have that, that's going to put a lot of pressure on that exit cap rate. So then it's probably not going to be 6.5, but it's probably going to be, you know, closer to 7.5, and that's going to be your, you know, that sensitivity side of it. If I can grab some additional CPI you know, and get to the 6.5, yeah, 16, mid-16 IRR doesn't, it's not a home run. This is a double at best, you know, if you want to look at it from a baseball perspective.
You talked about reusing the space within the actual compound, and I'm looking at the surrounding areas, and I don't think it would definitely work in this, but in a highly urbanized environment, would you look at taking the parking and maybe leasing that out separately and trying to generate, or is that?
Very hard to do because of zoning issues. So another piece of due diligence, as we talked about last class, is you know, you have to have minimum parking for a square footage, you know, kind of 4 to 1,000. More parking the better to attract tenants. If you build another building and you have no place to park, no one's going to lease from you. You know, the municipality won't even let you build it because there's going to be that density issue. So that's you know, that's where your upside is, but certainly
That depends on the lease, the business though.
It's regulation.
how so?
I don't know, I mean, is there, trying to think of times when they've built less parking because they're willing to bring people in via different methods of, like they're willing to subsidize a bus.
And it
ride,
depends on the
something like
business.
that.
It
Yeah.
depends on the tenant.
That's what I'm saying, the tenant.
Yeah.
If they're willing to subsidize people's bus routes or something
Yeah,
like
like
that.
for self-storage, you don't need a lot of parking because it's very transient. No one's hanging out there all day. So you move in, you dump a bunch of stuff and you leave. You're definitely not hanging out at your self-storage facility all day. So yeah, that's a case where you're gonna have less parking just because of a business operation. But I mean, this is an office building. People are here are parking every day. And maybe if you're, to your point about urbanization, yeah, Manhattan has no parking in their buildings because everyone's taking the train.
Right, that's what I was saying, it had to be an urban line.
Yeah, and that's a big thing with South Florida density is that everybody drives. You know, there's no public transportation. You have to have, you know, almost 1-for-1 parking or close to it for the you know, just to make it desirable. Anyway, we gotta wrap up.
Yep.
Okay, sorry. All right.
Dum dum dum.
Don't trash this because we will definitely on the 30th be starting with this, and then we'll probably take the quiz after we get into. We've got at least another hour into this thing because this is, again, the second half is going to be, you know, certainly much more emphasis on the quantitative side. And for those, you know, again, referencing chapter 9 and 10, I want everybody. I know we're in the first quiz on the 30th. We're going to take a couple steps back and make sure that all of this is setting in for you know, to finish up this class. So for those that still need some time, ask more questions, and certainly reach out to me between now and the 30th. And enjoy your holiday weekend next weekend.
Thank you, buddy. Yay.